Hi everyone, this is Rohit Srivastav. This is the 26th of September 2015. We just closed this week down after 2 weeks. I've been anticipating a counter trend move in the market for some time. And in fact, since it crossed the 77.15 mark almost 2 weeks ago, at that point, I sent out a note on the group uh, highlighting that we could be seeing a completion of a five-wave decline in the market. And subsequently, the next day, I wrote a more detailed note, a long shot update, highlighting three alternate paths that it could take. Whether it would be a fourth wave rebound, an X wave, B wave. That was the discussion. And essentially, when you're looking at a counter trend move, it's in three waves. We end up marking it as A, B, and C. And to the point that you actually reach wave B, it's usually very difficult to trade because you don't know exactly what form it's taking. And if the entire rise is a much smaller one, then the wave B can be interim. It can happen right in between the trade. And if it's a much more prolonged 3 to 4 week kind of pattern, then it happens much more slowly at some point. But the whole point here is that till you get to wave B, wherever it occurs, many times you find that a lot more stocks continue to fall to new lows because they're still forming their five-wave decline. So unlike the index, stocks continue to diverge from the index itself, and that can create a good amount of confusion, and therefore a lot of trades also tend to get stopped out. So the best part of a counter trend move is essentially in the wave C part, where participation would tend to appear a little more broad-based, and at the end of which breadth would be relatively strong. So we're probably heading into that part as we head into RBI week. Expectations being high that they'll move into cutting rates and maybe indicate more of that down the road. But I'm not so sure. I don't know how much he can really do and whether it's going to make any serious difference at all. So that's a completely different discussion. We've already seen the Fed hold back, but continue to stick to its point that they need to move towards higher rates or what they call a normal rate environment. And that's something they've been saying over and over again. So the expectations were high that they would do it now. So it was pretty surprising that they didn't. And still they continue to stress that they're likely to walk that path. So that can be really tricky because we do face heavy debt levels around the world, and all the volatility that causes cannot go without rubbing off on India, no matter what we might think about it. And we have our own problems, so we have to go through our own economic cycle. And if we are able to walk the middle path and get over it without too many knee-jerk reactions, the world market is definitely not helping us do it that way. So I think we're going to continue to see increased volatility. There is no doubt about that. And like I said, this is a counter trend move. I do continue to believe that your overall downward trend would probably continue for the rest of the year. So you'll get these big moves, 500,000 points on one side and then the other side, and you'll need to continue to time them. So what we got this week was just, I think we got a deeper knee-jerk reaction. We retraced almost 61% of the minor gains we made all the way from 7,500, 7,550 to around 8,050. And retracing 61%, that's very sharply in a couple of days, is essentially what wave B typically does. That's normal behavior. And as long as we hold this week's low, which is at around 77.20, we should be heading into wave C up. So that's what we will continue to expect, and ride it and look for where the end point is, and then look at what the next leg down would actually shape up as. There are a couple of more interesting observations from around the world. One of them is that even as we did fall into the fifth wave in early part of September, a lot of the world did not. However, this week we've seen the ADR index or the world index actually continue to a new low and complete, or probably is close to completing a fifth wave. And so you would see some kind of a retracement building up to that move maybe sometime next week. So that would probably aid the extreme selling that we've seen around the world. So we might aid a bounce back around different global markets. Also, what we have seen is a much more clearer turnaround in the trend for gold. I've been calling a bottom for gold for pretty long time, and we've seen it hit a low of as low as $1050, and from there we made the first higher top and higher bottom. This week we touched. Rather, last week we touched a low from where we've pretty much rallied a good $50, closer to the 1100 mark, and I think now we'll probably head closer to the 1200 mark in the next move, but maybe even overshoot that. So these are the early waves. I think we've just done wave 1 and wave 2, so the third wave of this current move might have started. It's still not clear in terms of you can continue to argue the longer term picture, but I think the entire 1 year pattern, since I've been writing about it, I think that entire 1 year pattern ended up being an ending structure. It has clear 5 legs within a channel, which I've marked as A, B, C, D, and E, and that typically happens at the end of a trend. So clearly whatever started in 2011 has probably ended this year. So you had a 4-year decline, which has retraced 50% of all the gains you saw from 2003 to 2011, and that should be the end of it, at least for now. So like I said, you can either argue that this is a counter trend move, retraces 50% of these losses, or else it's the start of a much bigger move to a new high, like a lot of the gold bugs have probably been expecting. And in either case, when we look at it in rupee terms, the base level has been close to the 25,000 mark. We've not been able to go below that, either because it was holding up in dollar terms, or even when it fell there, we saw a devaluation in our own currency, and that continued to actually help in pushing those prices up. So those have been that's been one major trend that has developed. So you need to keep an eye out on that, and it should be one important part of your asset allocation. The next major asset allocation, which I also discussed in the NDTV interview, and I'll probably post the link if I can find it on their website. The interview this week, we actually discussed what would be the apt asset allocation if we are actually in a downward trend. The next one would be to actually have some exposure to bonds, not right away, because you are now beginning to see what I've been writing about for since 2009, the counter type winter, which means a debt overload in the Indian market, and that debt overload initially did not seem to have an impact, but it's come into clear recognition from financial circles and economic write-ups. And now we are reaching the point where actually beginning to see an increasing number of defaults versus just the couple that we got in the earlier period. Now we are seeing many more suddenly creep in, and it's also now pretty clear that a lot of funding needs to be done, especially for the public sector banks. Almost 2 lakh crores or more than that needs to be put into them over the next couple of years. So that's a lot of dilution of equity that's likely to happen, and I'm sure that not the same size, but some amount of equity infusion even to the private sector banks would be a requirement. So there's going to be a lot of funding needs that need to be met, and where are you going to meet them from? Is it going to be from domestic liquidity, or is it going to be from foreign resources? And if the world markets are in turmoil, then foreign resources are not going to be easy to come by, and that directly puts pressure on interest rates. So the whole point is, even though we're trying to cut rates, we have a weak currency, and we can't really cut rates too far if world rates are actually going up. And moment that happens, it immediately puts pressure on your bond markets, irrespective of what you do with rates. Bond yields could spike up at some point of time, but like I was saying earlier, it's an important asset allocation. Once you get that spike up in bond yields, I think long dated bonds would be one more asset allocation. Essentially, because once we are done with that rate cycle, then the rate cycle will actually turn down, as many have been waiting for in the Indian market. So that will happen, but I just think we are early in that trade, and it probably happen. I sense now that we are into this stage of the bear market, maybe within the next 6 months, that cycle might have completed, and bond markets might actually have bottomed out for good. So I think these are going to be two important assets to watch. Gold probably has already bottomed. Bonds would probably an Indian bond I'm referring to would bottom somewhere in the next 6 months once we get that spike up, because that's a hidden potential risk that I'm continuously watching out for. And of course, the currency itself remains in a long-term uptrend. It's been slowly, gradually moving up with the dollar through most of last year. In fact, if you look at it, it bottomed in May of 2014, just around the election time. And when the dollar index started to rally, only it's moved up very, very gradually. So volatility has remained low, which was essentially what the RB wanted to achieve. But we are seeing smarter moves more recently. In the last 6 months, we've seen two rallies of a couple of rupees, and my sense is eventually somewhere in the next couple of months we could head to the 70 or higher mark in the currency itself. So those are going to be a couple of headwinds that I think we're going to be dealing with. Last and not the least, when we're talking of possible sell-off in the U.S. markets and potential for rising gold prices, the first thought should come to mind is the dollar going to be falling? It's been one of the biggest primary trends of the last year that the dollar index actually has been going up, and expectations have become so strong that if rates go up in the US, so will the dollar. But the dollar is actually moved in ahead in expectation of the rate cycle changing. So it's already discounting those expectations. And therefore, if you're building a case on the dollar simply based on future rate hikes, then it might be wrongly placed because the market's already discounted that, which is very similar to expectations of QE3 driving up commodity prices. But if you look at the peak in commodity prices in 2011, it happened just around when the last round of QE was announced. So I think we have a similar case with the dollar. The dollar's already discounted rate hikes, and a lot of money is already moved from various world markets that have been peaking over the last year and falling well ahead of the US market into the US, which is why the dollar has actually become stronger. And when you actually start getting rate hikes, it causes bond markets to actually sell off. And when that happens, a lot of the safe buying that has happened, which means global money moving into the US and buying US bonds, that selling starts, money would actually move out of the US market. So you'd actually see the dollar fall when you see US yields go up. So that's something that might be one of the primary drivers for gold prices to go higher. You might see a rebound, in fact, even in commodity prices because of all this. Even though it might not be more permanent, it might appear to be a temporary rally. We've seen a significant sell-off in commodity prices, so there's room for a counter trend move to actually develop there as well at some point. And a sell-off in the dollar might just be one of the triggers that might take place. So I think we need to be watchful of what the dollar is doing and what the euro is doing, which is one of the major components of that. Most other currencies, however, in terms of cross rates, might continue to actually fall against the dollar. So that would create enough confusion, even though the dollar index itself might come under pressure because of its relationship maybe with the euro or the Japanese yen, which were the main drivers of that move last year. Most other currencies which are not part of the eurozone or Japan might actually continue to weaken against the dollar. So that should create some confusion in terms of what people are expecting from the dollar itself. So to sum it up, there is no decoupling. When you have so many issues around the world, I don't think you can really decouple in a real sense. After all, a large part of our own growth cycle has been funded through foreign resources by allowing foreign investment into equity, into FDI, and now into debt to save our currency. 2 years back, we've gone excessively attracted money into the debt markets, and since that was the approach that RBI took, narrowing down the debt spreads between the Indian yields and the global yields really doesn't augur well for the whole expectation of a change in the rate cycle and protecting the currency from volatility. So that whole story on which this entire strength in the currency has been based on gets threatened by that essential fact that a lot of our growth has been funded by foreign money. The ideal situation would have been or should be that you're able to fund it through internal resources, but we've not really developed the market for that. We're still trying to de-bottleneck our own economy from all the systems and processes that we've created over the entire super cycle. So the Great Indian Super Cycle, which starts, with the inception of RBI and then our own independence, and everything that we've built since then, that needs to be rehauled. Probably only gets done through the kind of counter type winter cycle. So we continue to be in the final phases of the winter cycle. We have our own heavy debt loads that need to be corrected and that need to be adjusted through the system, which means the existence of defaults, allowing for bankruptcy, and funding all the banks. And once we are done with those processes, and the pressure that it creates will probably create also the momentum needed to push through those key reforms that actually de-bottleneck our economy into the next cycle of growth. And that said, that of course doesn't change the demographic story, which has always been around. So that's nothing new and it's not gone away. But financial cycles are made up of several aspects. So there's the technological cycle, the financial cycle of debt and money, the demographic cycle, and each of them interplay with each other to create the long-term, long-wave cycle itself. We are at the point where we need to correct our financial cycle while we're pretty strong in the demographic cycle longer term. We've never had really a great technological cycle, though we're mostly dependent on technology coming in from outside, from the rest of the world, which can provide us with our own productivity gains as and when we are able to adopt those technologies. But that said, the financial cycle, I think, is the primary one that we are dealing with right now, and should be in its critical phase over the next 12 months.
And since we are discussing the long wave cycle, the financial cycle, I thought I should go over this chart, which you can find for the long-term wave count on the homepage. And the big question that you should be asking is what can go wrong with this outlook, and why should we see an entire reversal in prices as I'm anticipating, or what can stop it from happening? So here's the thing. I've been expecting the fifth wave to end for a pretty long time. I identified that the economic cycle would actually turn down way back here in 2010, early part of that, and within 6 months we saw a peak in the infra and various other sectors which were the leaders of the prior period. So that looked like we were done with the fifth wave, either here or here. So we shouldn't have ideally gone to a new high, but we did. And even then, this run up, which I've been marking as a fifth wave, finally after a triangle, very similar to what we saw in 99 2000, is on the back of as narrow a list of sectors as was this previous peak breakaway to a new high. And what is also important is to understand what really drove us to this new high. So essentially, and what can still do it. So here's the thing: it's essentially government intervention. There's nothing else. Just like we've seen around the world, once you've hit the end of the cycle, the question really is: are you going to let the cycle complete its way down, or are you going to try and extend it through government intervention, which can come in a couple of forms? The first would be government spending itself. The second would be through introduction of some kind of QE. So if you actually go back and look at what happened after 2009, we initially did a stimulus for our economy, which led to double-digit inflation. When we did get inflation, we did not raise interest rates. We kept interest rates much lower than the inflation, which leads to what we call negative real interest rates. So that's a cost that we made the economy pay. And these usually act as stimulus for markets and asset prices. And the third one, which was OMOs. A lot of OMOs are open market operations, which is absolutely the same thing as QE, where you buy bonds directly from the market, were conducted by RBI during the 2010, 11, 12 period. And the end result of all of that monetary stimulus was a weaker currency. And if you actually see the gaining sectors of the last year, essentially they were the ones that were stimulated by the big move in the currency from the 40s all the way to 69. And now it's stabilized in the 60s. But that stimulus essentially is what has been priced in by the market by gains that you have seen in various sectors related to the external sector. So What would drive the market up again from here, and what would make this opinion of the financial cycle turning down and completing itself go wrong? Essentially, is a repeat of all of that. Government spending, OMOs, QE, along with lower interest rates, because low interest rates alone might not necessarily lead to interest rates being cut and being passed on. They may lead to some gains in terms of earnings for some companies, but whether it actually stimulates the economy. The second is, I've been talking about a weaker currency. Would that act as a stimulus? It can, but you have to look at why the currency would weaken from here. Would it be because of government related measures to stimulate? Then it would be positive for markets. But if it is actually related to outflows due to capital flight, or global related problems, then it might not necessarily be an immediate stimulus. Probably after the crisis is done, it would act as a stimulus. So we'll have to watch how exactly those factors pan out. But as long as none of these factors exists, and so far the mandate remains that you want growth without the risk of inflation. That's what the RBI talks about. That's what the government's mandate seems to be, that they don't want to deal with hyperinflation again. Then most likely the financial cycle, the debt related problems need to be corrected and addressed first before you can get back to being in a bull market. So that's all in this update. Thanks.